In an industry defined by volatility and transformation, internal strength is what fuels resilience. Our goal with this internal analysis is to uncover the strategic engines driving Chevron, from its core resources and capability to its operational backbone. Chevron is the second largest integrated oil and gas company in the United States that engages in all phases of petroleum operations, from exploration, production, and refining to marketing a wide range of oil, natural gas, and petrochemical products. To understand how Chevron has achieved this position, it is essential to look back at its rich history. Chevron's journey began when a group of explorers and merchants established it on September 10, 1879, with its initial name Pacific Coast Oil Co. or PCO. PCO was then acquired by Standard Oil Co. New Jersey in 1900s, marking the beginning of its affiliation with the Standard Oil Empire. After a merger with Standard Oil Co. Iowa in 1906, the company restructured and named Standard Oil Co. California or SoCal. In 1936, SoCal partnered with Texaco to create Caltex, California Texas Oil Company, combining their expertise to explore and market oil internationally. In the second century of SoCal, it had become a major company in the United States, and the Chevron brand was becoming familiar around the world. Company strengthened its leadership by acquiring Texaco in 2001, then later changed its name to Chevron Corp in 2005 and acquired Unocal Corp, enhancing its position as a leading energy provider. Years later, in 2020, Chevron continued its growth strategy by acquiring Noble Energy. In 2021, the company launched Chevron New Energies, focusing on hydrogen, carbon capture, and renewable energy solutions, aligning with its broader low-carbon transition strategy, aiming to foster sustainable energy solutions while maintaining its leadership in oil and gas sector. In 2022, Chevron acquired Renewable Energy Corp. (REG) to combine its growing renewable fuels production and leading feedstock capabilities with Chevron's large manufacturing, distribution, and commercial marketing position. In 2023, the company acquired VRIO Energy. The Chevron Way explains the company's beliefs, vision, purpose, and values. It guides how they work and establishes a common understanding of their culture and aspirations. A critic of their vision, mission, core values, and objectives will be presented, starting off with their vision and mission. Its vision statement paints a clear picture, looks into the future, is focused, and is memorable. However, the statement does not explain why this direction makes good business sense or how admiration translates to growth or industry leadership. Additionally, the phrase most admired is subjective and does not define what success looks like or who the admiration comes from. It should have indicated whom they are admired by: customers, investors, employees. The type of achievements are not clearly stated. While the vision statement avoids being overly long or present focused, it lacks a compelling, unique, and actionable vision. A stronger vision statement should clearly define the company's unique role in the energy industry and provide a measurable, inspiring goal. Its mission statement paints a clear picture, looks into the future, is focused, and is achievable, but it is too generic. It does not indicate what a directional path makes a good business sense, and it is not memorable. The statement aligns with the global energy trends, but it does not explicitly state why this approach benefits the company from a strategic view. This can be improved by making it more distinctive, specific, and inspiring to better differentiate the company and leave a lasting impression. Chevron's core values emphasize diversity and inclusion, high performance, strong partnerships, commitment to people and the environment, and trust and integrity. They prioritize ethical leadership, collaboration, and responsibility while aiming for industry excellence and sustainability. Despite the optimism of the company's values, Chevron still has a lot to improve when aligning corporate values with actual business practices. Chevron has faced significant ethical controversies, notably a legal dispute over environmental damage in the Ecuadorian Amazon from 1964 to 1992. Despite a court ruling in favor of Ecuadorians, Chevron resisted enforcement, contradicting its core values of trust and integrity by evading accountability. Additionally, Chevron's environmental violations, including major oil spills and misleading the public about fossil fuel risk, contradict its commitment to people and the environment and trust and integrity. Additionally, its headquarters moved from California to Texas, citing regulatory challenges, strain its partnership values. These actions suggest a gap between its stated principles and actual practices. Additionally, while the company claims to prioritize people and the environment, its recent plan to lay off 9,000 employees by 2026 to cut costs raises concern about its commitment to workforce protection. These actions highlight a gap between Chevron's stated values and its practices, underscoring the need for greater transparency and ethical consistency. So far, Chevron's objectives adhere to stretch goals because they are big, hairy, audacious, and are smart, specific, measurable, attainable, realistic, and time bounded. Now, who are the people behind the company? At the helm of Chevron is Michael K. Worth, serving as the chairman of the board and the CEO since 2018. He is crucial in shaping the company's global strategy and performance, overseeing major strategic business decisions and ensuring growth. Following him is Mark A. Nelson, the appointed vice chairman in February 2023, who oversees key strategic initiatives and policy development. Supporting them are various vice presidents and officers who oversee different divisions within the company. Moreover, Chevron also has Wanda M. Austin, leading the company's board of directors, working alongside 10 other directors. These directors bring extensive expertise from various industries, including science, engineering, technology, regulatory, and more, contributing to Chevron's corporate governance. Regarding the company's succession of leaders, there are no reported succession issues at Chevron, as leadership transitions have proceeded smoothly. Now, let us get to know how Chevron Corporation operates as an integrated oil company by walking through its business model canvas. The company works with oil and gas suppliers, equipment and technology providers, government and regulatory agencies, joint venture partners, research and environmental institutions, and financial institutions to support its extensive value chain. The core activities of Chevron include upstream, exploration, extraction, and production of oil and gas, midstream, processing, refining, storage, and transportation, downstream, marketing and sales of products. They also focus on health, safety, and risk management, corporate governance, and R&D to innovate and ensure sustainability. The core activities of Chevron include upstream, exploration, extraction, and production of oil and gas, midstream, processing, refining, storage, and transportation, downstream, marketing and sales of products. They also focus on health, safety, and risk management, corporate governance, and R&D to innovate and ensure sustainability. To support these, Chevron relies on essential resources like oil and gas reserves, production facilities and refineries, a vast distribution network, skilled workforce, including engineers and scientists, research and development capabilities, over 4,400 active patents, and strong financial capital. At the core of their business is a clear value proposition to provide affordable, reliable, ever cleaner energy. To build and maintain strong relationships, the company uses loyalty programs to retain customers, digital customer service tools for convenience and quick assistance, community outreach programs to stay connected with society, and personalized marketing campaigns to target customers' needs more effectively. Offered by Chevron were delivered through retail stations for direct fuel access, distributors for bulk supply, direct sales team for industrial contracts, as well as mobile app and social media platforms to stay accessible and relevant in a digital age. And speaking of customers, Chevron primarily serves individual customers who rely on energy for daily use, industrial companies which depend on large scale, uninterrupted energy supply for their operations. Moving on to Chevron's financial aspect, the company's cost structures comes from purchase of crude oil and products, which account for 50 to 60% of sales, operating, selling, and administrative expenses at 12 to 26%, and exploration expenses, which are 0.3 to 1.6% of sales. The revenues come from two main sources: upstream revenues from exploration and production, downstream revenues from sales, marketing, and distribution of products. Moving on to the PESTLE analysis, let's begin with the political factors affecting the oil and gas industry. Geopolitical conflicts such as the Russia-Ukraine war continue to disrupt global oil supplies, creating volatility in pricing and logistical uncertainty. Meanwhile, upcoming U.S. tariffs on imports from Canada, Mexico, and China threaten to increase costs across the supply chain. Regional regulations, like California's new fuel inventory law, further complicate operations, potentially leading to shortages and price hikes. The industry is also navigating economic headwinds. Currency fluctuations and inflation impact profitability and planning. However, strong GDP growth in emerging markets presents an opportunity, driving up energy demand and supporting long term revenue prospects. Societal shifts are reshaping the energy landscape. A growing preference for renewables and increased climate awareness are pressuring the fossil fuel industry to evolve. This shift is not only changing consumer behavior, but also raising expectations around sustainability and corporate responsibility. Technological advancements are opening new paths. The rise of green hydrogen and renewable innovations create opportunities for diversification and transition. At the same time, AI is enhancing operational efficiency, enabling smarter decision making and cost reduction across the board. The legal environment is tightening. Stricter emission regulations are increasing compliance costs and requiring major investment. Litigation risk, whether environmental or contractual, pose ongoing financial and reputational challenges for companies in the sector. Environmental factors remain at the forefront. Climate change continues to disrupt operations through extreme weather events and resource constraint. Yet, growing investor and public pressure for sustainability also presents an opportunity for those who can lead the transition and build long term trust. Another crucial part of the environmental analysis is getting to know Chevron's major rivals. These are Shell and ExxonMobil. To understand Chevron's performance better, Dauntless Consulting Group has prepared a financial analysis. Starting off with the horizontal analysis, Chevron's total assets have shown a steady increase each year from 2020 to 2024, which suggests continuous growth. The total liabilities appear to remain relatively stable across the years, with slight fluctuations indicating controlled debt levels. Lastly, the total equity has increased over the years, which suggests that the company is generating retained earnings or attracting more investments. Based on the 4-year CAGR, the company is experiencing strong sales growth, 20.97% CAGR, and improving asset efficiency as shown by the 18.9% increase in total asset turnover. While net income and return on sales have declined, these challenges present opportunities to refine cost management and profitability strategies. Liquidity ratios shows that the company was in its strongest position in 2022, with the highest current, quick, and cash ratios indicating solid ability to meet short-term obligations. However, by 2024, all ratios declined. Current ratio dropped to 1.1 and cash ratio to 0.18. This may be explained due to build-up in inventories over the years, increasing current liabilities, and decreased current assets. Chevron's solvency ratio shows that the company initially utilizes equity financing, particularly supported by the decreasing trend of liabilities ratio and debt to equity ratio in the years 2020 to 2022. However, the trend of these ratios slightly increased in the year 2023, suggesting that Chevron shown signs of increased dependence on debt financing. While the liabilities ratio exhibits a continuous slight increase by the end of 2024, debt to equity ratio decreased in the same year, indicating that the company adapts equity financing during the year. Chevron's profitability improved significantly after 2020, with positive operating margins starting 2021. Gross margin peaked at 46.68% in 2022, while operating margin hit 15.02% in 2023, reflecting strong operational performance. However, 2024 shows a slight decline across margins and returns could be attributed to its increased expenses during the year compared to 2023, especially in its purchase crude and oil and operating expenses. Meanwhile, COGS remained high at about 60%, slightly rising, indicating pressure on gross profits. And return on equity peaked in 2022 but declined afterward until 2024, that may be attributed to increased costs incurred by the company. Chevron's efficiency peaked in 2022. Inventory return rose to 19.19 and receivables turnover reached 12.13, showing faster movement of goods and quicker collection of receivables. Moreover, fixed asset turnover also peaked at 1.62, strong overall use of its fixed asset. However, by 2024, these ratios declined slightly, especially fixed asset turnover, which dropped to 0.56, suggesting a slowdown in operational efficiency despite still relatively stable performance. Chevron's debt peaked at 2022 at 2.13, then declined to 1.28 by 2024, still showing a favorable control over leverage despite its decline due to the simultaneous decreased cash flow on operations and increase in total debt in 2024. Cash flow to revenue was highest in 2022 at 0.21, but significantly fell to 0.16 in 2024, indicating a slight drop in cash generation from operations and revenue generations. Dividends payment also peaked in 2022 at 4.51 and declined to 2.67 in 2024, reflecting Chevron's reduced ability to pay its dividends to shareholders through its operating cash flow. Such decline is due to the decrease in operating cash flow, while the dividends paid continuously increase. And lastly, for financial ratios, it shows in DuPont ratio that from 2021 to 2024, we can see the company's profitability improving, peaking in 2022 at 23.08%. Although there was a dip in the following years, with 2024 ending at 11.49%, the performance still shows steady and healthy returns compared to the earlier years. For the analysis part, let's start off with the value chain analysis. Here's a quick look at Chevron's value chain framework, how they create value for its target customers, starting with support activities. First, procurement. Chevron partners with over 26,000 suppliers worldwide, ensuring a consistent flow of high quality supplies. Technology development. Chevron invests heavily in exploring renewable energy solutions. They're also integrating cutting edge tools like AI, drones, and robotics for efficiency and safety. Then, human resource management. They prioritize diversity, inclusion, talent development, and employee well being. Finally, firm infrastructure. Leadership is guided by the Chevron Way, a commitment to operational excellence, with principles like Stop Work Authority, in which employees are empowered to immediately halt unsafe operations, ensuring safety always comes first. Proceeding with their primary activities. For inbound logistics, Chevron processes around 800,000 barrels of crude oil daily, receiving and storing oil, gas, and raw materials at refineries and terminals. In their operations, they focus on exploration, extraction, and production in upstream, and midstream activities include processing, storage, refining, purifying, and transportation. Their pipelines move crude oil, gas, and chemicals. For outbound logistics, Chevron focus on packaging, transportation of products to distributors, retail stores, and other end customers. We have over 128 billion gallons of products distributed yearly through a global network of wholesalers, retailers, and industries. For marketing and sales, Chevron promotes its fuels and lubricants, uses digital tools like OnePort, and offers a wide range of products to meet diverse consumer needs. And lastly, their after sales service includes oil condition monitoring, technical assistance, and strong customer service for retail and industrial clients. Shown on the screen is the activity map of Chevron, highlighting the key activities in Chevron's oil and gas operations. These activities are divided into three major segments: upstream, midstream, and downstream. Chevron's tangible resources across four categories, starting with physical resources, which include refineries, pipelines, retail stores, and a 50% stake in the Bayou Bend carbon capture project. Technological resources cover advanced facility designs, solar power, grid electricity, hydrocracking, and digital technologies. Financial resources consist of capital investment, operating revenues, and equity investments. Organizational resources highlight Chevron's global structure that supports its upstream, downstream, and new energy operations. It operates in major capital projects worldwide, such as Gorgon and Wheatstone in Australia. And intangible resources include human capital, brand image and reputation, intellectual property, and its culture, the Chevron Way. Group also analyzed Chevron using VRIO framework to assess its competitive advantage. First, global upstream operations. Chevron produces 3.1 million barrels a day in 2023 through a globally anchored upstream portfolio. Its large-scale oil production provides value, but competitors like Shell and ExxonMobil have similar operations. While costly to imitate with $14 billion allocated for upstream in 2024, it is not rare, which results in competitive parity. What is the current strategy of Chevron? Chevron's strategy is built on cost leadership, technological innovation, diversification, sustainability, and global expansion. Cost leadership. Chevron focuses on operational efficiency to keep costs low. It uses an operation excellence management system to enhance safety, reliability, and resource efficiency. Chevron also has an integrated business model, handling everything from exploration and production to refining, marketing, and distribution. This allows the company to control cost, manage risks, and respond quickly to market changes. Next, technological innovation is at the heart of Chevron's strategy. The company uses artificial intelligence, automation, and data analytics to improve operations, enhance safety, and reduce environmental impact, ensuring it stays ahead in the energy sector. But innovation isn't just about efficiency, it's also about responsibility. Chevron is committed to sustainability, investing in low carbon technologies, cleaner energy solutions, and renewable energy projects. These efforts align with global environmental goals and help position Chevron as a leader in the transition to a more sustainable energy future. Another major aspect of Chevron's strategy is diversification. It has a direction towards fostering sustainable energy sources, which include adding new products and services to the existing ones, including harnessing solar, Another major aspect of Chevron's strategy is diversification. It has a direction towards fostering sustainable energy sources, which include adding new products and services to the existing ones, including harnessing solar, wind, and biofuel energies. And finally, global expansion plays a key role. Chevron continuously seeks new market opportunities and strategic partnerships to ensure long term growth and resilience, even amid economic and geopolitical fluctuations. Group also analyzed Chevron using VRIO framework to assess its competitive advantage. First, global upstream operations. Chevron produces 3.1 million barrels a day in 2023 through a globally anchored upstream portfolio. Its large-scale oil production provides value, but competitors like Shell and ExxonMobil have similar operations. While costly to imitate with $14 billion allocated for upstream in 2024, it is not rare, which results in competitive parity. What is the current strategy of Chevron? Chevron's strategy is built on cost leadership, technological innovation, diversification, sustainability, and global expansion. Cost leadership. Chevron focuses on operational efficiency to keep costs low. It uses an operation excellence management system to enhance safety, reliability, and resource efficiency. Chevron also has an integrated business model, handling everything from exploration and beginning with Chevron's strengths. Chevron boasts a robust production capacity, a diverse portfolio, and a broad asset base, helping them remain resilient across economic cycles and fluctuating energy demands. They operate in over 180 countries, providing them with strategic access to markets and energy reserves worldwide. Also, the company's vertical integration strategy allows it to streamline operations, from exploration and production to refining and marketing, leading to greater efficiency and cost control. Chevron also benefits from strong brand identity, enjoying consumer recognition and credibility across continents. Moreover, Chevron is a technology leader in the energy sector. It pioneers advanced drilling techniques, leverages reservoir modeling, and uses data analytics to optimize performance. On the sustainability front, Chevron is making investments in renewable energy and is actively deploying carbon capture, utilization, and storage technologies, highlighting its initiative to reduce its environmental footprint and adapt to the energy transition. Despite these trends, Chevron faces several critical weaknesses and threats. First, the company operates under intense regulatory and environmental pressure. It has been penalized by the U.S. Environmental Protection Agency and continues to face global scrutiny over its environmental record. The company is consistently ranked among top 100 polluters worldwide, a reputation that clashes with its sustainability messaging. Chevron is no stranger to the courtroom either. A recent legal dispute with ExxonMobil and CNOOC over Hess stakes in the Starbrook block in Guyana has drawn headlines and raised questions about Chevron's international partnerships. Fluctuating net income also challenges Chevron's financial stability, influenced heavily by volatile oil prices and global economic conditions. In addition, the company's oil and gas reserves are in decline, dropping from 11.1 billion barrels of oil equivalent at the end of 2023 to just 9.8 billion by the end of 2024. Chevron also recently moved its headquarters from California to Texas, a decision attributed to increasing environmental regulation and legal action in California, including a lawsuit for allegedly misleading the public about fossil fuels' impact on climate change. It's also worth noting that California's step-out reservoirs played a role in this relocation, reflecting broader resource limitations. In summary, Chevron is a powerhouse in the energy industry, with technology, scale, and brand strengths on its side. Yet, the company faces an uphill battle as environmental regulations tighten, public scrutiny grows, and its traditional resource base diminishes. That ends Dauntless Consulting Group's internal analysis for Chevron. Thank you.